let's get across to Mark Todd, who joins us right now from FIIG Securities in Sydney. And Mark, just to stay with that theme today, if you don't mind, love your call there from FIIG on the CPI that's due out in a short time and how you'll be reading it.
I mean, I think everyone's hoping for it to 1.2, and that keeps within the band of 3%, but they'll be looking for that core number to see what the RBA can discount, you know, what they can say will link to the floods and the various pressure points. You know, we are very keen to see what the wages growth will look like. There are going to be some high inflation numbers in the education piece, so I think they'll be dissecting every number in the hope they can bring it under 3% as best they can.
Do you think there is already wages pressure then?
You know, it's an interesting thing. I actually am coming to the view that there is definitely, you know, when we talk about a two-speed economy, I think there's probably a two-speed economy in the wages piece. I think the growth in some of these wages numbers are so extraordinary in the mining communities that they're not actually transferring out into the broader communities as well. I think they're just saying, I actually think it's more an expansion issue now. I think the wage differentials, we go to see some of these cities on part of our trips to customers, and some of the numbers that we're hearing, people say, look, I'm not even going to be able to match it. It's no point in trying to go above it. So if you can't work in the mining communities, you have to accept the dollar that's being paid here. That just means that, you know, as you see staff transfer out into the mining communities, you're actually seeing a contraction in the growth within those, you know, other cities.
Right, and so, but net, you get this overall, well, perhaps benign-looking number. It's a balance.
And you see that in the consumer sentiment, where you know, you'd expect everyone to be very confident, but they're not really. So if, you know, we went into the Central West just before Easter, and we're going to towns like Dubbo that are affected by the mining boom, they're saying, well, there's certain works that we're not going to be able to do because we don't have the staff. So we're telling our investors or our communities, just expect, you know, less road growth or less expansion, because we're not going to pay those wages that are out in Singleton.
So that's true. How should the RBA be responding to that? Because it's all about keeping wages contained, basically.
Well, it is, but it's also about the retail number, it's about the consumer spending. I mean, we've been saying for a while now that the key to this is the consumer. If they continue to bank those dollars, the RBA is going to be pretty happy. They're going to say, this is the, you know, the perfect storm. You know, we're having good export dollars, and we're banking the money. If you go out into the farming communities at the moment, they're looking at the currency at 108, and we spent some time with some of the farmers and said, you know, what happens at 110? They weren't happy. You know, that's not a good result, and that doesn't help the confidence. You know, they're seeing some good commodity prices, but they're at the same time saying, you know, I'm worried about the ability to sell. So they want to bank as many dollars as they can. One of the things that was very interesting to us was when we went on the recent trip was the capital costs had become cheaper due to the currency rise, and they weren't inclined to go out and buy as much machinery as possible. Whereas in periods gone by, they would have been buying as much as they could get to restock the farming communities. And that's not really happening yet. Yeah,
and so inflation, when you're talking about consumer spending, I mean, this is where inflation expectations come into it as well. Even things like, you know, the electricity prices, people talk about electricity prices going up, and yet that doesn't actually feed so much into the CPI as people might think.
That's true, but the other thing is, as everyone talks about it, people start to use less.
Yeah.
You know, and I think we see the political rhetoric at the moment. Everyone is fighting so hard over this carbon tax, the effect on the energy, and I think it makes everyone conscious of the energy as an issue. Even before the prices go up, they start to use less. They talk about it a lot now.
We should check in on the corporate bond market with you as well, Mark, because that's what we usually chat with you about.
That's right.
We've got
and royal weddings. We can do that.
You want to do it? You're in for our panel on Friday. Okay, good. Excellent. I'm glad you've taken up the challenge.
Perfect.
There has been a bit of an increase in corporates going directly to markets, bypassing banks.
Correct.
There's been a bit of activity surrounding that. What are you guys suggesting is actually driving that?
I think it's the cost of funds. I think we saw recently Woolworths did a 5-year issue at 105 over the BBSW rate, and CBA did a similar issue at 105 over, so there's no margin that CBA could pass on. It's cheaper debt for Woolworths. They go straight to the market and they're able to access the same funding as the banks.
And you're seeing lower rated borrowers actually issuing then at the same rate as the banks?
That's correct. I mean, I think, you know, it is an anomaly with the banks, and they're saying that you know, it's not yet a concern, but it's one of the issues around the fund managers. I think the fund managers saying, like all of us, we want to have a balanced portfolio, and there's been so much bank issuance. It makes sense to buy some corporate debt. So, you know, you average the return out over a period of time, the credit return, the physical return. It makes sense to buy some of these good Australian corporates easily sold.
You're saying all of this is actually good for the banks. Why?
Well, I think that there's some people will say there's an opportunity cost to the banks because they can't issue on behalf of Woolworths. I would say that a broader expansion of the debt market is a good thing for the banks. It makes them, it opens the avenue for them to bring other issuers into the market.
Mark, I have to leave it there for timing reasons. We could chat so much more. Thank you so much. And Royal Weddings later in the week. Thank you.
Okay, bye-bye. See ya.
Bye. That's Mark Todd from